Okay, well, good morning, everyone. So today is the 28th, October 28th, and we're going to pick up from where we left off last time, talking about Chapter 8, dealing with inventories and everything sort of concerning inventories. And but we're going to finish up talking about just sort of a piece where we sort of left off last time, dealing with gross and net method in terms of purchases. And one of the recurring themes about this chapter is the sort of interplay between the periodic and the perpetual inventory systems. And so this is something that the text talks quite a lot about. We covered it in Principles 1, but it's something that you really have to sort of see examples of. And I think that's what we're going to do today, is see some examples of how these differ in terms of their approach to arriving at ending inventory, cost of goods sold, and all that. So and it really makes a big difference. And so, and again, and when I talk about ending inventory, which is obviously a balance sheet account, cost of goods sold, which is an income statement account, we come back to this idea that we're really covering throughout the rest of this course, mostly balance sheet items. But it's, as I've said before, really difficult to sort of disentangle income statement figures from the balance sheet. That's how intertwined they are. So we are primarily focusing on inventories here, obviously a balance sheet account. And so, and that's what we're really talking about. So, or set of accounts. And so just for this section only, I know that there's another section that uses these videos, which I'm happy to share. And they may be on a different schedule. So for those of you who are in the Attend Anywhere, AO1, AO2, the due dates for the Chapter 8 work for this week are Friday, the 31st. I'm sorry, it's Halloween. So hopefully you can tell before that if you have kids who will need Halloween. And then Sunday for the homework. But also the second exam is coming up on Sunday. So, and hopefully we'll have some time on Thursday to talk a bit about the exam. If you have questions, in the meantime, feel free to get with me. Okay. So for this section only, I don't know what Natalie's sections are doing in terms of timeframes and whatnot. But I'll let you know. Also, just to kind of let you know, I'm working on updating the grading. I got a bit behind in this, and I'm not really sure why. Some of the grading, the grade book did not quite transfer over very well, and we're having some trouble getting some things transferred from Connect to Brightspace. And so I spent a long time working on that. I know that a lot of you are wanting your results from exam 1. And so what I would suggest to you is, if you really are just, I think I mentioned this in a previous video, if you really want those exam results from exam 1, just get with me and I'll do them in real time with you. I have no trouble doing that. But I'm working on that. I'm trying to get things a bit current. I apologize. I really have been doing this for a while, so we've kind of gotten a bit behind, but I do want to get everything current and structured so you can sort of see what's going on in the grades area, my grades area within Brightspace. So, okay. So this week we're going to cover Chapter 8. We're going to finish this up on Thursday, I'm pretty sure. And then we can talk about any questions you may have. And again, feel free to get with me if you do have questions about what's happening. We'll talk about the exam. And then from there, we'll go on to other parts of the financial statements, particularly the balance sheet, as we progress throughout this course. Okay. All right. So any questions so far? Okay. Well, I think where we left off last time, we were talking about purchases and we're talking about discounts. And this is sort of where we left off. It was an area where we were talking about this idea of we acquire inventory, particularly. I think of purchases as mostly being inventory. And the example here is Covington Mattress buys mattresses from Simpson Manufacturing, no relation, I presume. And they did it on August 16th. They received an invoice for $12,000 with payment terms of 210 net 30. Okay. So remember, when we talk about purchasing inventory, there are occasionally discounts offered for early payment. And we call these cash discounts, as opposed to trade discounts, which may be due to a lot of other factors like good customers, volume customers, and whatnot. This is really a cash discount. 210 and 30 is obviously a very common, sort of credit terms offered. And so if they use the net method, how do we record the purchases? Okay. Remember, the net method is assuming that we're going to take the discounts. Okay. So we're going to assume that we take the discounts. And if we don't take the discounts, then we have another account that offsets that discount that we call discounts forfeited or lost or whatever you want to call it. There are different terms for it, but in this case, it's $12,000, 2/10/30 on August 16th. So how do we record the purchases in the net method? We record it assuming that we're going to take the discount. 2% of 12,000 is going to be, what is that, $280, and so, or $240, I should say. And so as a result, we're going to book that right then and there at the discount. Okay, we're going to assume that the discount is going to be taken. And purchase discounts, I think by now, hopefully everyone's got the idea that discounts, when they're offered, I'm talking about cash discounts for early payment, when they're offered, if they're offered, they should be taken. If they are those discounts are greater than the cost of capital to acquire, say, borrowed funds, and a lot of times, as a former banker, I can tell you we advance lots and lots of money to people in order to take discounts because sellers want to be repaid early and get the cash in hand for whatever reason, right? It incentivizes buyers to pay early, and so even if the buyer doesn't have the cash on hand, they can borrow it. And bankers, assuming that the buyer is a good credit risk, are more than willing to lend money for that purpose. And so as a result, that's the issue there. So under the gross method, however, what do? Well, to same terms, only here we book it at 12,000. So we don't make any assumption that the discount's going to be taken. Okay. Now, I think I said in a previous video that I sort of like the gross method a little bit. And maybe I'm being a purist here, I don't know, but until a discount is taken, I don't know that we should claim this because we're booking this right away into inventory, right? And whether it's perpetual or periodic system, we're booking $12,000. And whether we take the discount or not, if we take the discount, that's fine. And if we take the discount, the economic effects are going to be the same, whether we use the gross or the net method. But I don't know, maybe others would disagree with me, but I kind of think the gross method is a little bit more rigorous. I know I'm probably in the minority here in terms of academic accountants in this regard, but nonetheless, GAAP accountants, well, I shouldn't say GAAP accountants, GAAP standards sort of favor the net method, I will tell you that. So at the end of the day, we're going to get to the same place. And by the way, this disagreement is not one that's going to have long-ranging ramifications. I mean, we're going to get to the same place at the end of the day. I think the big issue is how do we account for it up front, and how do we recognize and communicate to users, particularly, remember, these are external users, how do we communicate to users information that they can use to do whatever it is they're going to do with it, right? And so that's really the key thing in terms of priorities. Okay, and then we're going to talk a bit about perpetual and periodic systems here, and then we're going to get into some other issues regarding inventory. So this is really sort of an interesting piece, I think, of this course. I know revenue recognition, as I said earlier, is probably one of the centerpieces of this course. But one of the things I think, for whatever reason, I've been at this a bit, is people always talk about inventory and how we deal with inventory evaluation. And let's be clear about what we talk about perpetual versus periodic systems. We're talking about different methods of recognizing cost of inventory in the inventory, and therefore how we translate that to cost of goods sold on the income statement. And the two systems are maybe a little bit different in this regard. Theoretically, they'll get us to the same place, but they're different. And obviously, a lot of us have a definite affinity for perpetual systems. I think I talked about this in a prior video. They are a real-time adjustment of things that are happening in terms of inventory and cost of goods sold. Periodic systems, we sort of think about as old school, but I did sort of make an allowance, and I still make an allowance for those organizations that have a small amount of inventory in relation to total sales. Maybe they're more of a service organization, and inventory is not that big of a deal, and the accounting for it is not a priority to management, frankly. In which case, a periodic system may make sense. Okay, so it's not a question of one being better than the other. It's as I've said many times before, it's one that's more appropriate for the type of organization that we're dealing with. So, all right, so we'll come back to this Lothridge Wholesale Beverage Company. They buy soft drinks from producers as manufacturers themselves, and they resell it to retailers. So they're a wholesale company. I mean, the word wholesale is in their name, right? So they began the year with merchandise inventory of 120 on hand. During the year, additional inventory transactions include, and we have all these lists of different transactions. purchases of 260, better terms, freight charges, merchandise was returned. Okay, so that's a thing. All purchases on account were paid within discount period. So the 210 issue meant that they were taking the 2% discount. Sales and account, this is something we're going to need, 830,000. The cost of soft drinks sold, which is a COGS account, cost of goods sold 550. And ending inventory was 174. So they're done according to both the perpetual and periodic system using the inventory method. So what are we going to do with this, right? We get this information here, but what is it we're going to do? So we're going to compare side by side what's going on here. So remember, so one of the big things we should talk about in the periodic system is we're going to have a purchases account. So this differs from the perpetual system in the fact that we buy inventory, and this is in thousands, so we chopped off 3 zeros here. We're going to debit a purchases account and accounts payable. These are on account, right? And but in the perpetual system, we're going to book it straight to inventory and the accounts payable. So it's a little bit different. And then the freight charges, freight is obviously a cost of the inventory itself. And so under the periodic system, we're going to book a debit to what's called freight in. Freight in is an inventory account. Here, we're just simply debit straight to inventory, right? So it's going to be part of the cost of inventory going forward. That's one of the advantages to this particular system. And we're going to pay cash, the 16,000. And these are what we would call aggregate journal entries. These are not one journal entry. These are all the journal entries for this accounting period. So, okay. And then returns, we're simply going to debit or credit out of inventory and reduce accounts payable. And here, because we're now booking the goods in inventory, we're going to credit this to a contra account called purchase returns, which is basically a contra asset, and accounts payable is the same debit on both sides. Okay, and the discounts payable look something like this, where we have accounts payable we're going to pay, but we're going to reduce the cost of inventory by the amount of the discount, right? And that's what's going on here. The purchase discounts are going to be taken. It's going to reduce the cost of the purchases to begin with, and then the cash is going to be the same in both cases, right? So the business facts are not different, really. And that's one of the things that I think we should emphasize is the facts on the ground are not different. It's how we do the accounting for them, right? And theoretically, whatever method we use, I mean, I know we talk a lot about different methods being used for all kinds of different things. I mean, and the list goes on of the dozens of hundreds of items we deal with, but theoretically, we get to the same place. It may take some time to get to the same place. We get there. Here, we're going to get to the same place, but it's the advantages really to the perpetual system are that they give management an idea, a window into what's happening. And one of the things that I think is really important and is talked a lot about in financial accounting circles these days is the idea of visibility. And a lot of CEOs, CFOs want to come in the morning and see what happened, not just last month, last quarter, whatever, but yesterday, and find out what's going on. And they want reports, and they want data, and they want information. And because without the old school adage, it goes way back. If you can't measure it, you can't manage it. And so they want to know what is happening, and they want good information. So the perpetual system definitely does that. The periodic system is what it is, and obviously the same cash disbursement is there if taking the discount, which in this case is happening. Okay. All right. So any questions before we sort of move on here? And so we'll talk about some of the differences here. And I don't want to spend a lot of time on this because it's sort of a rehash of what's going on. But in the perpetual system, we have receivables and sales revenue. Remember, we're going back here. Now, one was on the cost side, which was on the purchases side. Here we're on the sales side. So we have accounts receivable, sales revenue, 830. Where that number come from? It came from right here, right? And so we had $830,000 in sales, and they were on account. So we have sales and accounts receivable. Those are, again, aggregate journal entries. Same deal here, really. Nothing really different. Only in the perpetual system, as we sell goods, we recognize cost of goods sold. And this is one of the things that we see over and over again with perpetual systems is that if we can tag that good with a cost of goods on a per unit basis, really, where applicable, we can debit cost of goods sold immediately in credit inventory. and we remove it from inventory right away, and off it goes, right? Again, technology is really the driver here. You got to be set up to do it. Most big companies that sell lots of inventory have this set up, and so perpetual is the more modern way of doing it in this regard. So, and then there's no entry at the end of the accounting period because we've already accounted for it, right? Otherwise, we have to go back to this exercise here where we have all these items under a periodic system. We have cost of goods sold, which is going to be the same, but it's really this idea of any inventory, returns, discounts, and all that. So all this that we've talked about before, that's have to sort of go into the calculation. Okay, so in many ways, the perpetual system is is used as the perpetual system gets better, as technology gets better. I think we're going to see that used more and more as we go. Okay, now this is really now we've got that sort of out of the way. Now we're going to get to inventory valuation. This is, I think, really the heart of this particular chapter segment, and it's the idea of how we value inventory based upon the facts on the ground, and how we then value ending inventory, which then affects cost of goods sold, which then affects net income, which affects retained earnings on a balance sheet. And you can see these things go on and on and on and on. One thing leads to another, to another, to another. But it goes back to this idea of how we value inventory. If you're an inventory organization, and we're talking about manufacturers, wholesalers, retailers, companies that deal with inventory merchandise, this is really a lot less applicable to service organizations. And it really is, because of the fact that one thing about service organizations is whatever inventory they have is either zero or negligible, and one can account for it however one wants to account for it. Even expensing it, I mean, in the current year, without even putting on the books as an asset to begin with, that makes sense. But for the most part, though, we're talking here about inventory, and one of the things I think I said at the outset of one of the previous videos was the idea. I think a lot of people struggle with inventory, and I'll tell you, I sort of struggle with it because it was so foreign to me. But the thing about it is, you just kind of slow down, just take it in. If you're frustrated, get up, take a walk, go away, get a cup of coffee, do whatever, come back and look at it. Your brain will process this information over time. It will get better and better and better. Believe me on this. I can tell you from long experience, if you're frustrated, just, come back, which is why we say accounting should be learned and over time. And you really can't rush it unless you're, a super genius and whatnot. And I do not put myself in that category whatsoever. So, all right. So let's take a look we have the Browning Company, and we're going to sort of take a look at what the issues are here. So we've got beginning inventory during 2021. So starting the year, we have 4,000 units and a unit cost of $550. So we have total cost, basically price times quantity, or quantity times price, whatever you prefer. And so obviously cost of inventory is a dollar figure. And then we have purchases January 17th, March 22nd, October 15th. Now we're going to take these same facts for quite a while here, because we're going to get into different assumptions as to how the inventory is flowing, and therefore what the cost of goods are going to be, and obviously his effect on net income. So as a result, we're going to have purchases of $1,000 at $6, $6,003, all the way quantity price all the way across. Okay, and if you add these up, you get 71,500 that are goods available for sale, or the GAPS account, right? Goods available for sale throughout that entire accounting period, which is usually a year, right? And whether it's from January 1st to 12/31, it's up to the company itself. But we're talking about the goods available for sale for the entire year. Okay, but they sold some units, and they sold 2,000 units on January 10th, sold 1,500 on April 15th, and sold 3,000 on November 20th. So out of the 11,000 that were available for sale, that is the 4,000 to begin with, plus the purchases, they sold 6,500 units. So as a result, we're going to have an ending inventory amount. And the big question is, and then they really sort of work together. What is the ending inventory figure, dollar figure, which then translates to a cost of goods sold figure, so that we can get to an income statement. Remember, in financial accounting, the four main statements, and we're excluding comprehensive income statement here, which is sort of, I guess, maybe 1A. But there are four statements. Income statement comes first, and then we go from there. So the income statement is the first, and then we create the other statements as a result of that. So These are out. And by the way, this makes sense because these are all temporary accounts. As we close them out at the end of the accounting period and we start over. So as if it's a fiscal year end of 12/31 at midnight of New Year's Eve, we close the books out and we start again with the next year on January the 1st. And so we zero this out. And when I say we zero them out, we simply dump them into an income statement account so that we can do financial reporting and the new year begins again. This is different than the balance sheet, which is more permanent and it changes, but it changes because of other areas, other things that are going on. And a lot of this we're going to cover in subsequent weeks. So talk about units available. So we go back to the beginning inventory of 4,000. We had 7,000 units, and we have goods available for sale of 11,000. Inventory on hand at the end then is simply 11,000, and we subtracted, and we have 4,500. So obviously 11,000 minus 4,500 is 6,500. Okay, so the math here is not particularly complicated. It's beginning inventory plus purchases minus sales, right? We're just talking about units here, just individual units. We're not getting into dollar figures. We'll get into that here in a second. And so we have units sold 6,500. But we're sort of given that. We sort of know that's what's happening. Okay? So ending units plus sold units is 11,000, and that brings us back to goods available for sale. And these have got to reconcile. If they don't reconcile, we've got a problem here. We have to figure out what the problem is. Okay? So that's what's going on in terms of just units. And again, a lot of accounting deals with units, but obviously, ultimately, in financial reporting, you want to get to dollar figures. And so let's do that. Let's sort of make our way there in terms of talking about what's going on. So, okay. So, so here we are to dollar figure. Wait a minute. I think I missed a step here. But there we go. Okay. So in this case, we have a beginning inventory of 4,000 at 550. Where did that number come from? It's just given. I mean, 4,000 at 550. That's quantity. 4,000 times 550 price is 22,000. Okay. So, and that's the beginning inventory. We had purchases of 7,000 at various prices, but if we add all these up together, we're going to get the difference between 22,000 and 71,500, which is going to be 49,500. We're going to get to the goods available for sale, which is a dollar figure. And then the ending inventory is a question mark. And it might seem like, why is that a question mark? Well, maybe it is, right? But we're going to determine what the value of the ending inventory is. Remember, we're not in any ambiguity about the units in the inventory. If we go back one here, right, the ending inventory in terms of units are 4,500. The question is, what is the dollar value of that inventory? And then related to that is, what is the cost of goods sold related to that inventory? So this might seem like settled business, and I know that sometimes we think that accountants are only simply recording what happened, but sometimes it's interpreting what happened based upon different approaches of valuation. So we know what the facts are. The 22,000 purchases, those are all documented. Those are, we have source documents to provide that. So we have 71,500. The question is, what is the value of the inventory? We know the number of units, but we don't know the value of it. And the reason we don't know the value is because we have to apply a cost flow assumption. There's a different inventory method based upon what our particular preferences are. And I think that's really what is going on here. That's sort of the heart of this whole thing. So let's talk about different approaches. And we're going to start with one that is not so commonly used, but it is used. It's called the specific identification method. You may recall this from Principles 1, wherever you might have taken it. These are goods that are usually very large, big ticket items, where there are very few items in inventory on hand, and it's very easy to account for the goods. And we can say, this good we know cost us this, and this particular good we sold at this. Now, that might seem like that's completely obvious, and it may seem like every seller of goods throughout the economy ought to be able to use this. The reality is it's not that easy, because there are a lot of sellers that buy multiple different purchase layers at different times at different costs, and we have to make different assumptions about those. Specific identification does not really adhere to that particular methodology. It's the idea we're talking about, unique items, cars, sort of fit in this character. And by the way, in terms of, and this is maybe a bit of an aside here, but in terms of internal control, a lot of times somebody within these organizations will sort of count the beans. I hate to use that. I really hate that term a lot, but they'll count the inventory. We're talking about car dealers, jewelry stores, where there are very few items on the hand, but they're big ticket items, and so they'll count them. And so in this case, the accounting is fairly easy, right? We know what it cost us to bring the good to the market, and again, we go back to all the figures that go into what is the cost of a good. That is, freight in, the shipping costs and whatnot that are paid, and we dump in inventory cost, all that sort of thing. And so we know the cost, and so we know the price, and so as a result, we can match up cost versus price. Hopefully, the price, which is external value between buyer and seller, exceeds the cost, which is an internal matter. And so, otherwise, you've got a real problem. And if you do it over and over again, you can sell some goods at a loss, but you can't lose money all the time. So, in this case, we're selling unique, expensive products: antiques, cars, jewelry, artwork, things which don't move a lot, and there's not a lot of volume. I never worked in a jewelry store, but I knew people who did, and one of the things that's interesting is that they would spend like Monday through Thursday not selling really anything, and then Friday, Saturday, and Sunday just goods are flying off shelves, and so it was just kind of a weird dynamic about how that sort of worked, particularly at mall locations and whatnot. So, and I think in most cases they would tag the specific price of the product to the cost of the product to the price. So specific identification made sense. In this case, we talk about unique serial numbers that can be used to match a specific good. So that's not common. It really isn't. I know that I worked in an investment firm where we, on some transaction, would use specific identification for things like option transactions, which I'm not really going to get into here, but it's not common. It's not all that common, particularly as the economy is sort of dominated by organizations that deal in large volumes of merchandise, and so it's a little bit different. Okay, so it's not all that common. So we talk about cost flow assumptions. So this leads us then to really what I think is the heart of this chapter, and that is inventory valuation. It's an area that it's business students for decades have struggled with this, and I get it. Believe me, I'm on your side here. I really am. It's the idea of how do we assume what the value of inventory is that's both been sold and which remains in the inventory. How do we do that? And in a lot of ways, I think this is counterintuitive to logic, and but welcome to the world of accounting. So companies can assume which units of inventory have been sold and which remain in the inventory. So there are some cost flow assumptions. And by the way, we're omitting here specific identification, because specific identification is theoretically the most accurate, right? But here's the problem. You're Walmart. You're selling 50,000, I don't know, maybe 500,000 bottles of shampoo a day, right? I have no idea how many bottles of shampoo Walmart sells, but are you going to tag every single individual bottle of shampoo worldwide that Walmart sells? Probably not. It's going to be difficult. You just can't do it. They're not unique items, right? They've been purchased at different times, and so you're going to do that. Now, maybe at some point in the future, we can tag every single item of inventory over time. Maybe we'll get there, but we're not there yet. So as a result, we got to use these assumptions, okay? And so the assumptions we're going to use, which do not include specific identification, are average cost, which is perfectly acceptable, FIFO, which is first in, first out, LIFO, last in, first out. So let's talk about all these and talk about how they differ in terms of inventory valuation. And by the way, we're working our way toward ending inventory, which then implies what the cost of goods sold is, which is obviously going to have an effect on net income. Net income then is going to have an effect on retained earnings. Retained earnings is going to have an effect on the balance sheet. So one thing leads to another, leads to another, leads to another. So we got to make sure that we're rigorous in our accounting and we're consistent, and that maybe most importantly, really is the idea that we're communicating to users what is going on, right? What it is we're doing, why we're doing it, and all that. So, all right, so let's take a look at average cost first of all. So, same facts here. We have beginning inventory of 4,000 units at 550. That's 22,000. That's basically quantity times price, right? We have purchases of 7,000 units at various prices. And we don't really know, we don't really care what those prices are. We just know the aggregate is 49.5. So we have 71,500. So these are the same facts as we discussed earlier. And we're going to sort of keep these same facts as we keep going throughout this chapter. And we have ending inventory at the end of the year of 4,500 units at 650. Now, we'll talk about this idea of how we get this weighted average figure. And so therefore, goods available for sale, the gaps minus ending inventory gives us cost of goods sold. Okay. And so obviously cost of goods sold is going to be somewhat different in a unit price. And so here's the thing. We take 71,500, which is the goods available for sale, divided by 11,000 units, and we get $6.50. That is the value of units that are sold, right? And we're valuing not just the goods sold, but also the ending inventory, okay, for that particular accounting year. All we're simply doing is we're taking one figure and we're saying this is both the ending inventory figure and the cost of goods sold based upon an average. And in a lot of ways, there's a lot of virtue to this particular system because it sort of evens out some of the discrepancies in prices. And I think one of the things I should probably mention at the outset here is the idea that prices, the assumption is prices are going to go up over time. So if you buy a good in March, it's going to be cheaper than the good you buy in October or whatever. And that's a pretty good assumption. It doesn't always hold in every instance, and there are some markets in which prices are wildly fluctuating and whatnot, but we're going to make that assumption, and it's going to sort of inform the decision on the part of management as to what method to adopt. In this case, here, all we're simply doing is saying goods available for sale. So remember, going back to this, remember the periodic system, one of the virtues of the periodic system is it sort of clarified what the facts were. We have beginning inventory plus purchases equals gaps, goods available for sale, minus ending inventory equals cost of goods sold. Or you can invert these last two terms. If we know cost of goods sold, we get ending inventory. Okay. But here, all we're simply saying is all the goods available for sale were 11,000 units, right? Going back to our original scenario of beginning inventory of, I forget what the number was here. Where was it? 4,000 units plus 7,000 units is 11,000 units. I think I lost my way here. And we get 71,500. And so as a result, then we take an ending inventory and we get cost of goods sold of 42,250. And the weighted average cost is this. And we say weighted average because the fact that it does tend to, if we have larger purchases, those have a bigger weight than smaller purchases, even at different prices. And so as a result, we end up with one particular value. This is perfectly acceptable. It's used a lot in the business world, the average cost method. And one of the things we're going to see as we get going in this chapter is the idea that organizations of any size will sometimes use different methods depending upon what their reasons are. And we'll particularly talk about LIFO as being a particularly problematic issue. And we'll get to that here in just a bit. Hopefully we'll have time to get to that today. If we don't get to that today, we'll definitely get to it on Thursday. We definitely need to talk more about LIFO to LIFO, right? But we'll get there. So in this case, in the perpetual method, we're gonna do a moving average each time additional inventory is purchased. Now remember this, highlight this, think about, lock this down. Every time inventory is purchased, and this is not just the average method. It could be FIFO, LIFO, whatever. But every time we purchase inventory, we recalculate the value of inventory, and that's what perpetual systems do. And this is the virtue of perpetual systems, is the idea as new inventory is added, we simply recalculate everything. Current inventory, which then affects the price of the next goods sold, all the way down to ending inventory values, and ultimately cost of goods sold. So the new average is determined after each, using the average purchase method here. So we're going to sum all the previous inventory and the cost of the new purchase, and we're going to divide it by the number of units on hand. That's going to give us the average cost of the average unit cost, right? Well, it's kind of redundant. The average cost of inventory. So we go here in the perpetual system. We have 4,000 units on hand at the beginning of the accounting period at $22,000. So 4,000 at 550. We sold 2,000 units. So what does that mean? We sold 2,000 at what? At 550, right? Because the cost of goods is updated as we begin every accounting period, or as we bring in new purchases. So it's 550. So 2,500 is 11,000. So what remains, we sold 2,000. So we start with 4,000. We have 2,000 remaining at what value? 550. So 11,000, right? And then we have more purchases, $1,006. And notice the prices are going up. And this is something that we oftentimes talk about, is the idea that prices tend to go up over time for a lot of reasons. And so we simply book those in inventory. So remember, we have what now? We have 11,000 plus 6,000. I'm sorry, 11,000 plus 6,000, which was this 11,000 plus this gives us 17,000. And the units are the 2,000 that did not get sold for the original balance, plus the 1,000 we purchased, so we have 3,000 units on sale. So what are we doing? We're going to take dollars divided by units. So 17,000 divided by 3,000 is 567 per unit, rounded, right? So that becomes the new unit cost as we go forward. And this is really what the advantage is of the perpetual system, is the idea that everything updates in real time. And system and computer systems allow this, and without complicating the matter, because inventory becomes very, very complicated. We may have thousands of different items that we're doing this for, right? Hundreds of thousands of items, maybe. So, but you get the idea here. So everything's updating. So in the case of the new purchases here, we simply incorporate this in the picture here. And we simply say, okay, we had some left over from the original purchase, or the original beginning inventory plus the sales, right? And that leaves us at 2,000 units. And then we had another 1,000 units. But we start with 11,000, and we had a new 6,000. So it's 17,000 divided by 3 is 566. 567 per unit, right? All right, more transactions are happening. And by the way, this particular scenario is going to sort of carry itself through to FIFO and LIFO and all that as we get going. So, and we're going to do a comparison of what these effects are on the balance sheet and income statement both as we get going. So in March 22nd, they bought 3,000 more units at $7. Prices are rising, so 3,000 times 7 is 21,000. So as a result, we have 38,000. So remember, we had 3,000 units after January 17th. Now we have another 3,000. We have 6,000 units, and we had a value of those of 17,000, and we're going to add 21,000 more to that, which is 38,000. So 38,000 divided by 6,000, that is dollar figure divided by units, is going to give us a unit price here of 633. So 633 becomes the new unit of value of these goods. And these are cost of goods, right? Per unit, okay? All right, let's move on. April 15th, we sold 1,500 units, right? At a price of what? 633. Why? Because this updated as of that time. So quantity times price is 9,500. And so as a result, we're going to subtract that from the value. So we're going to have 28,500 remaining. We bought 3,000 more units at 750. So quantity times price is 22,500. So what do we have? Take this 22,500 plus the 28,500 from the previous inventory balance. 28,500 plus 22,500 equals 51,000. And that's the dollar figures. The units are, we had 6,000 plus another, we had 4,500 plus 3,000 is 7,500. So 51. So together, 51,000 divided by 7,500 is $6.80 per unit. And then one other thing, and I'm not going to go through this in such excruciating detail with FIFO, LIFO, but all these events are going to happen, and we're going to sort of track the differences in valuation as we go. So on November 20th, they sold 3,000 units. At what? Well, and this is the cost. There's not the price of the good. We have no idea what the price of the good is. We don't care here, right? We just know the cost of the good is $680 per unit. So 3,000 quantity times price is 20,400, which we're going to subtract from 51,000, and we're going to end up with cost of goods sold of 40,900. Now, where did 40,900 come from? We're going to, and these are obviously going to go back all the way to the beginning of the year here, and it's going to be, we're going to have 11,000 here, right? That's when all the green in the sold column, 11,000 plus 9,500, which is what, 20,500, plus another 20,400 is 40,900, and that is cost of goods sold using average cost under the perpetual inventory system. Okay. And this is something you just kind of got to follow what's going on, and don't rush yourselves. Just kind of take a look at and see what's happening, and as you are looking at it, understand what's going on with regard to any inventory and cost of goods sold. But the thing is that everything is updating in real time, or more or less real time. And that's really one of the virtues of the perpetual system, is that it takes into account these sort of differences. In this case, we're using average cost. Now, there are other methods that we're going to get to. This is one that is not, I don't know, it's probably not as commonly used, but why did I spend so much time talking about it? Because I want to sort of make clear what we're trying to account for here. That is beginning inventory plus purchases and sales, how we end up with ending inventory, and what is cost of goods sold as a result of that. So remember, that's one of the virtues of the periodic system, is it does sort of lay out for us the mathematics of the idea of goods available for sale minus ending inventory equals cost of goods sold. And that becomes the income statement figure, and it works its way through multiple statements as we get going. Okay. All right. So any questions for anybody here or elsewhere? So remember here, the beginning inventory figure was that 22,000, and all we're simply doing is we're sort of making adjustments to that based upon activity. Okay, and let me talk about cost of goods sold. All right. So now let's get into FIFO versus LIFO. All right. So these are things that should not be unique and new information. You can't take intermediate accounting until you've had intro to accounting. And we're going to talk about first in, first out, shorthand FIFO, or last in, first out, or LIFO, and talking about what's going on with FIFO and LIFO. So FIFO assumes that the first goods that come in to the organization are the ones that go out. This seems pretty logical, particularly for goods which are of a nature where they're going to deteriorate quickly, they're going to expire, like eggs or milk or bread or whatever. So it makes sense. And so the first goods in are the first goods out. And I think a lot of business managers, particularly retailers and wholesalers, would like for this particular methodology to hold, where they want to get old stuff out, get it out of there, and the newer stuff remains in inventory until they sell it. So in this case, first in, first out is sort of logical. So in this regard, what are we doing here? So we're going to go back to the original facts that we started with. We had 4,000 units and 550. So the units sold here are 22,000, right? We're going to now the pink here is going to be cost of goods sold. This is not cost of goods sold. This is in the inventory. So we're going to add goods here, and so 4,000, 1,000, 1,500. What do we know about the facts of the case going back to the original scenario, which was admittedly a different system? It was the average method. So we know that we sold what? We sold 6,500 units. Now, where do these numbers come from? We sold 2,000 here, right? And we sold 1,500 there. That's 3,500 plus 3,000. We sold 6,500 units. So we know we sold 6,500 units. The question, and so 11,000 to begin with, we sold 6,500. 11,000 minus 6,500 gives us 4,500 in the inventory. The question is, how do we value these? That's really the big issue here. So in this case, what we're going to do is we're going to create layers based upon purchases, and we're going to sort of reduce those layers as those layers are sold off. So if we sold 6,500 units, then we know that we're going to sell the first 4,000. We need to sell 6,500. The first 4,000 we began with, right? And we're going to sell the next 1,000 at different prices, right? 4,550, 1,006, right? And then we need 1,500 more, right? And those are at $7. And so as a result, if you just simply take quantity times price all the way across, add them up, we get cost of goods sold of 38,500. And if we go back to the issue of the beginning inventory minus cost of goods sold equals ending inventory, we should have beginning inventory minus 38,500 equals ending inventory of 38,500. Because what's remaining are the newest goods, right? And remember, on March 22nd, let's go back to March 22nd, right? We had to split that invoice in half here in order to make the accounting, because on March 22nd, we bought 3,000 units, right? This guy right here, right? We bought 3,000 units, but we didn't sell 3,000 units, right? We only sold 1,500. So half of that invoice, half of that purchase, half of that layer, whatever you want to call it, which was at $7, they're going to carry over in ending inventory because we didn't sell it. That makes sense? So what we did sell with these guys here. So we're selling first in, first out. And so as a result, we have cost of goods sold, simply quantity times price all the way across. And what we did not get sold is 4,500 units remaining, quantity times price at 33,000. Okay. And that's the FIFO method. The FIFO method assumes that the oldest goods are going to be sold first. Okay. And it makes sense, and it sounds like, hey, this is completely logical. Why does everyone use FIFO and whatnot? And a lot of companies do. In fact, it is the majority. A majority of companies use the FIFO method for inventory because it kind of makes sense. It's also easier to implement than other methods like LIFO. And LIFO itself is it's kind of a jungle. You're going to get into it, and there are all kinds of different variations as to LIFO. And we'll talk a bit about LIFO. LIFO is particularly problematic. When I talk about the idea of inventory evaluation being difficult to students of intermediate accounting, I'm really primarily talking about LIFO, I think. And LIFO has got its own sort of issues there. So, and by the way, as we get going toward the end of this particular segment, we'll sort of compare average cost versus FIFO, average cost versus FIFO and LIFO. We'll put them together in a matrix that will allow you to sort of see what's going on, so you can sort of judge for yourself what's going on. So again, all this, the same facts as above in terms of purchases, sales, dollar amounts, everything is the same. Okay. All right, so we're going to go to, when we talk about FIFO, here's what's going on. In the perpetual system, we have all these different elements going on here. So the balance of the inventory account adjusts perpetually after each transaction. So in this regard, what do we have going on here? So remember, we started the issue with, and I'm assuming this is January the 1st here, 4,000 units at 550, 22,000. We sold 2,000 at what amount? At 550. So as a result, 11,000. And then we had more purchases, 1,006 and 3,007. Let's take some time. I know this is a bit tedious, but I really think this makes a lot of sense. Let's talk about what's going on here with these layers, because it's really going to be the difference between FIFO and LIFO as we sort of get into it. So we started the year with 4,000 units at the same price, right? 22,000 in inventory, okay? And so we sold 2,000 of those at that same price. And so as a result, we're now doing 2,000 at what? At that price, 550, 11,000 at January 10th. Then we bought goods on January 17th. We bought 1,000 units at $6. And we're assuming these are all homogeneous goods. Again, we could take this across tens of thousands, hundreds of thousands of goods to do this, right? But that's why the virtue of the perpetual system allows us to do this. So, all right, so let's take this example. Another 1,000 units at 6. So as a result, what do we have? Well, we had the 2,000 remain. The 4,000 we began with, we sold 2,000, and so 2,550 plus this new 1,600. I'm sorry, $6. And so you add these together. Quantity times price is 17,000. And that is what? That's the inventory value. And we're assuming these are finished goods. I think that's something we should talk about. These are not goods in process. These are finished goods. We're talking about retailer, merchandising operations, or even wholesalers. It doesn't really matter. I mean, wholesale and retail is only different in the sense of the scale of operations and what they do. So it's more of an operational thing than it is an inventory valuation. So we ended up with 17,000 on January 17th. We bought more, 3,000 units at $7. So we have all this plus the new layer, 3,000 at $7. And so if you do the math, quantity times price, all the way, you get $38,000 at the end of March 22nd. Okay. Again, what we're doing is we're updating the inventory figures as we go, and this is what the perpetual system does. But we're not done yet with the year. So in April we have what? We have some sales. Okay. And we sold 1,500 units at 550. Okay. 1,500 units at 550. So where did the number come from? Well, it came from this, right? That was because we're updating these as we go. So as a result, they sold some units, 1,500 at 550. That's 1,850. So think about what's happening here, okay? Under FIFO, we're selling the oldest goods first. Let's go back to the inventory layers here we got, right? Which is right here. 1,500, they're going to be at 550. So how do we know at 550, right? How do we know that? Because we're saying the oldest goods are going to be sold first. So we sold 1,500 units, and we had 2,000 from that particular purchase layer, right? So we're still going to have 500 left over, but the price per unit is going to be 550. I'm sorry, the cost per unit is going to be 550. So as a result, what does it end up looking like here? We only have 500 units remaining after that sale, and then the other ones are remaining. And what other ones? The other ones are these guys here that still remain. Okay, they still remain because we haven't sold them yet. So that's essentially what's going on. And then we're going to add one more layer of purchases here, and that's going to be on October 15th. We're going to add 3,000 units at 750. We're going to book that right here, right? Okay. And so that's going to be good. And then we're going to sell on November 20th. And let me go back. I forget what. November 20th, we sold. We sold. Let me see here. I can find what's going on here. I got to go all the way back here. So we sold a bunch of units. I know that. So, okay, we sold 3,000 units. Okay, we sold 3,000 units. So, all right. So let's go back to 3,000 units. So we sold 3,000 units. That's right here. Okay. Let me go back to 500 here. Right. So 3,000 units are sold. I gotta go. I went too far here. Right here. So 3,000 units were sold. Sorry about that. I'm trying to keep track of the all the sales, and so 3,000 units were sold. So this is where it gets really interesting because we're using first in, first out. So remember, as of October 15th, which is the most current update as to all these purchases and sales, we're continually assigning unit costs to inventory because we need to know what it costs us to bring a good to market, right? And as we approach the end of the accounting period, we sell 3,000 units. That's 500 plus 1,000 is 1,500 plus 1,500. But where does it come from? Well, we're going to liquidate this. 500, 550, that's gone, right? That's done. We have another 1,000, right? That's done. That's six. And then we need another 1,500. And it's going to be 1,500 of the 3,000 here. So it's going to be quantity times price all the way across. 19,250. 19,250 subtracted from inventory and 52,250 gives us ending inventory of 33,000. Okay, that's ending inventory. Remember, these are when we say balance, we're talking about inventory balances, right? But this particular product, this particular SKU, whatever it is, so as a result, we have that ending inventory. The cost of goods sold is 38.5. Where did that number come from? Well, let's figure it out. Where did that number come from? It came from all these sales. Remember, cost of goods sold is cost of goods that are sold. So it's 11,000 on January the 10th. It's 82.50 on April 15th. That's 19,250 plus another 19,250 on November 20th gives us 38.5, and that's cost of goods sold. Remember, there's an inextricable linkage between ending inventory and cost of goods sold here. So in the FIFO system, we have 38,500 cost of goods sold. Okay. And then we have remaining what? We have the goods that remain that are oldest. The oldest are gone, the newest are still in inventory. Okay. And that's what's going on with the FIFO system. In FIFO, it makes a lot of sense. The most recent numbers I saw, which has been a while, but is that most companies use FIFO because it's easier than other systems like weighted average or it's certainly like a LIFO. LIFO has got a lot of problems. We're going to talk about LIFO here in a second. And when I say problems, I simply mean complicating factors and different twists on LIFO, some of which I think you may pick up in intermediate 2. I think you may come back to that. I don't teach intermediate 2, but I think LIFO and all its various manifestations comes up again. And it's interesting and tricky thing that really requires lots of concentration. So that's FIFO. So any questions about FIFO and what's happening with FIFO and as goods that the oldest goods are sold first, and the newest goods are the ones which remain in ending inventory. And so those are the things that we need to account for. Okay. All right, let's get into LIFO. LIFO is the same facts as before. last in, first out. So we cover this in the principles courses. We're saying the same facts apply. We're going to sell the same goods, right? 6,500, and the same goods remaining in the ending inventory, but everything's flipped on its head here in the sense of which goods are sold first. And that's really the big difference between FIFO and LIFO is an assumption. And let's talk a bit about LIFO because it's a particularly tricky sort of topic, and it's one that sort of trips people up a lot of times. But the idea is that we're talking about this idea of the same facts. So we go back to the same facts. Just flipping back to FIFO, we sold 6,500 units, and we have 4,500 units remaining in the inventory. We go back; it's the opposite case here. The 6,500 units that we sold are the newest goods, and the oldest goods are the ones which remain in the inventory. Okay? And all we're simply doing is we're saying, okay, with each layer of purchase, particularly in a perpetual system, we're going to create a different cost of goods sold, right? A different unit cost. And the big question is what is sold, because that's going to then have, or what's the value of what's sold, because that's going to then have an impact on ending inventory and cost of goods sold. So in this regard, we simply said 6,500 units. Well, what are 6,500 units? We're going to sell the 3,000 at $750, boom, right? 3,000 at $7 there, boom. And we need 500 more units. It's going to be this 500 at the 6, which by the way was 1,000 of a purchase layer. We're going to split that in half, and we're going to assume that only 500 of that 1,000 were sold. So as a result, we add these together here, quantity times price across this way, add them this way, we get 46.5. And obviously, goods available for sale minus ending inventory is going to give minus cost of goods sold is going to give us ending inventory. So we're going to get a different ending inventory figure. What does it mean? It means the oldest stuff remains on the books. The oldest stuff remains on the books. We're selling the most recent stuff, and as a result, those are the values that we're going to use for this. And so the cost of goods sold here is going to be in blue, right? So ending inventory is going to be in blue. Okay. All right, so let's kind of go forward here and talk about what's going on, and we'll talk about LIFO, and also manifestations. And there's a reason why I sort of walk through all these transactions under the FIFO method as well as the weighted average method, because it really is important to understand what's going on. Again, the same facts apply, the same instances. We start with the same beginning inventory, the same sales and whatnot. But the big question is, how do we account for them? So under the perpetual system, we're saying what? Okay. So we have, and our lives are kind of easy here because we have one layer of inventory, 4,000 units at 550. So we sold 2,000. Well, it's going to be at 550, so 11,000. So nothing is different so far, right? Everything's the same. The trouble will remain as we get going. We had new purchases, and so we add to those, right? And we had more purchases here, we add to those. And so nothing is really all that different here as we get going. The idea is, though, unlike the FIFO method, where we go back to the original layer of transactions, now we're starting to sell the older batch first. So in this case, on April 15th, we sold 1,500 units. And those 1,500 units are going to be from where? Not the oldest batch purchased, right? Or layer. It's going to be the newest. So it's going to be at $7, right? So we bought 3,000 units here at $7. We're only going to sell 1,500 at $7, which leaves us 1,500 at $7. And we're going to update the inventory account right then and there, right? And we're going to go on. We bought 3,000 more units at $750. That's going to go there. And we sold 3,000 at $750. That's going to totally go away. So we're going to end up with this, which is really this last layer just simply disappears because we've sold it, right? We bought on October 15th. We sold November 20th. So as a result, we end up with what? Cost of goods sold are all these blue figures here, which is 11,000 plus 10,500, which is 21,500 plus 22,500 is 44,000. And that's the cost of goods sold figure under the using perpetual inventory systems under the LIFO method. Okay. And it's going to be different than what we got with FIFO. We had 38,500. Here we have 44,000. Okay. You might think, well, this is rinky-dink. It's only, what is it, $6,500. But what if we had, 3 zeros, 6 zeros, 9 zeros, whatever? I want to figure it might make a big difference. And LIFO's got its advantages, it's got its proponents, and we're going to talk about that. We've got about 10 minutes. And I do want to sort of get into talking more about LIFO because I think sometimes it's really confusing as to why it even exists, and what's going on with that. So before we do that, let's talk about the cost flow methods. And so under the average cost, FIFO and LIFO, we have what? Goods available for sale are going to be what? They're going to be the same. They're very same, right? So nothing is really changing here in terms of goods available for sale. Assuming we're going to start applying one method or another going forward, right? So ending inventory, so goods available for sale are going to be the same. The difference is ending inventory with across all these systems. And so we're going to have average cost, which by the way is going to be the midpoint roughly between FIFO and LIFO, right? Somewhere in between these. Maybe it is not the perfect midpoint, but it's going to be there. So you're going to have a higher ending inventory with FIFO, right? And a lower ending inventory with LIFO. And we're going to talk about why this is an important distinction here. So it's going to fall in between. FIFO results in a lower cost of goods sold and a higher ending inventory. Think about this. FIFO, lower cost of goods sold, higher ending inventory. So lower cost of goods sold means a higher net income with all the same facts, right? A higher net income, right? And LIFO is going to have a lower net inventory and a higher cost of goods sold, meaning a lower net income, right? And during a period of rising costs, FIFO results in a lower cost of goods sold and higher ending inventory than LIFO. During declining costs, it's just the opposite. I think we could sort of rule out the from a realistic standpoint, an issue of declining costs. I mean, there are some industries in which the price of goods are falling, but we're in an inflationary environment right now. So I think we're sort of back to this idea of LIFO having this advantage of having a lower net income. And that's really what we're sort of getting at here. And we're sort of working our way toward it. I really do want to sort of capture that today. So, all right, so same goods available for sale. The issue is ending inventory and what to do about it. So again, you're going to have a higher ending inventory and a lower net income with FIFO or with LIFO, and that's really what's sort of happening here. Okay, and it's important for us to understand this sort of distinction. Now, the methods used do not have to apply to what the physical flow is whatsoever. It really does not. This is something that kind of freaks people out, is the idea that it really doesn't make any difference what the physical flow is. It seems wrong. It seems ridiculous. And by the way, in the international standards, I think it's probably safe to say that the international standards do not agree with the U.S. Version of this. Let's see. I'm trying to pull up a browser. I just want to kind of show you I can pull it up here. I want to show you an example of a financial statement, and I'm going to go with Kroger here. Okay, I'm going to pull this guy over here so you can see it and talk about what's going on here. So Kroger is it's the largest retailer, grocery retailer in America, and they own Smith's, and they own, if you've been traveling around, they own King Soopers in Colorado and some other places as well. And certainly in this part of the country, Kroger is the parent company of Smith's. And so I want to sort of talk about what's going on here. And I want to look at inventories. And so I want to come down here and talk about what's going on. So we think about groceries, right? What is it interesting? What can we say about groceries? These are goods that are going to kind of go away, right? They're going to depreciate. So in this case, let me try to blow this up a little bit here. So, and I can give you the link if you want this, but so what do we have here? We have the Kroger Company is founded, what I was trying to find where this was here, where they talked about inventories. Oh, it's right here. Okay, inventories that stay at lower cost, principally on a last in, first in basis. Lower cost, LCM, which means lower cost of market, means if inventories have depreciated in value, we need to mark them down. It's part of the concept of conservatism, so lower cost of market. But usually goods are not going to lose value as they're sitting on shelves, but they could, right? But we're going to do it on a LIFO basis, right, primarily. And so 91% of inventories in 2023, 89% of inventories, we're using the LIFO method. So think about this. These are eggs and milk and lettuce and cheese using the LIFO method, meaning that inventory on hand that remains is old stuff that was bought in 1986 and 75 and 1960 and whatever. And so this is a very strange issue here, but this is an example of the fact that it does not have to mirror the physical flow of goods, okay? And I know a lot of times people, and I've had a lot of students say, well, this is insane. How can you possibly say that the goods on hand is in the inventory are representative of the asset values? Well, it's a good point. It's a good question. And by the way, in the international standards, we'll get to that in a second, LIFO is not allowed. And I think one of the reasons why LIFO is not allowed is because under GAAP accounting, LIFO is allowed for a very long time, particularly during inflationary periods. And in inflationary periods, like we're sort of in now, we're not that serious in an inflationary period, but in an inflationary period, it's advantageous tax-wise to use a LIFO method, even though most companies don't use it. But I pulled this up because I think it's a pretty good example of a company that definitely does not have goods that were, you don't have a box of cheese that was bought in 1960 and it's still on the shelves, right? But we're using the accounting method that makes that works with this. So I get totally why the international standards do not allow LIFO. And so, by the way, what happens is a lot of companies will do business across international boundaries. Most of our public companies do it at this point. And what they'll do is they'll value inventories in those areas at the FIFO or average cost method. And there are some other methods like the retail sales method. There are other methods now that we're not going to cover here. But LIFO is forbidden, so they will not value them there, but they'll value LIFO here. So it's problematic. And but here's the thing: your text has got a very good discussions. If you try to revalue every inventory that was valued at FIFO, or I'm sorry, LIFO, and made it FIFO, you'd have a huge issue where companies would have to sort of step up a recognition of income that will probably be taxable. And we don't talk a lot about tax here. I'm a tax accountant by trade. I'm more of a tax accountant than I am a financial accountant, but it would be a taxable event. So, and there are certain industries where this is gigantic in terms of numbers. Oil and gas comes to mind, the extractive industries and whatnot, some of the ag industries. And so as a result, LIFO still exists. I don't know how we get out of this, but as your text so eloquently talked about, it is probably the biggest hang-up between convergence of GAAP and IFRS standards. I don't see any way out of this, and American companies like it. By the way, for those accounting nerds like myself, I'm an academic accountant, I don't practice any longer. There are debates about LIFO, and there are passionate defenders of LIFO in the US. And one of those was Walmart. Walmart argued vigorously it is more representative of their inventory flow, their cost flow, than FIFO, by saying, look, we get a case of toothpaste, and we pay whatever, and it's gone that day. Isn't that LIFO? We get it in, it's done, it's gone. And if you've ever been to Walmart, and like me, there's a Walmart sort of near my house, and if you get there at 8 o'clock at night, the inventory is wiped out, it's gone, right? I can't find toothpaste or paper towels or whatever, it's gone. So it's a pretty good argument. We get stuff in, it's gone, in, out, in, out. However, you could also say, well, that's also the case for FIFO, because where's the old stuff that people were supposed to have bought? If the inventory is wiped out, then where is the older stuff that should have been there? So I know Walmart fought vigorously with FASB to maintain LIFO, and yes, it's very political. There's no doubt about it. I can tell you it is what it is. And so we are dealing with LIFO domestically. Whether that will change over time, I don't know, but that's essentially what's going on. So this is sort of an example of that. So I pulled up Kroger. I'm not picking on Kroger. I kind of grew up with Kroger and whatnot. So and talked about the idea of LIFO. But it just kind of it's very striking though, the idea that you got a grocery retailer, most of the goods will expire, right? Even as canned goods, they're going to go away at some point. You can't buy a can of green beans, expect them to be good in 50 years or whatever, but they're going to remain in the inventory forever, until we get to what we call LIFO liquidation, which I don't think we're going to have time to get to today. But I just want to sort of point out to you the nature of the argument here and how it really influences what's going on. So in this case, we have FIFO, LIFO, all permissible under GAAP. Companies don't use the same method for different inventory. And this is another thing too. They may value some inventory at FIFO, some at LIFO, some at average cost. There are other methods as well, which are a little bit less common. So companies can use all kinds of different methods. And here's a sort of a breakdown. I don't know what the source of this is, but it's not really sourced to. But FIFO is most widely used. And one reason why is because it's easier to apply. It really is. LIFO is, there are a lot of complications with LIFO, but a lot of companies find it's worth it to deal with those complications for reasons we'll get to in a bit. And then average cost is almost is in use as LIFO. These are public companies, and so as a result, you get the idea of the sort of breakdown here. FIFO is much more used because it does make sense. It does match the cost flow. It's a little bit easier. A lot of companies do not want to go through all the jujitsu that really is involved with LIFO. So quick quiz here. We got to go. Fulbright uses the periodic inventory system during its first year. They made the following purchases in order of acquisition: 160 at 50, 280 at 40, 60 at 30. And this is relatively easy. I would not overthink this at all. If you see this on homework or quiz, sales for the year total 1,080 units, leaving 40 units on hand at the end of the year. Ending inventory using FIFO. Well, all right. So it's 40 units. Well, FIFO means the oldest goods are still on hand. So it's going to be 40 at $50, right? There's nothing really complicated about that. So 40 at $50. Wait a minute. I lost my hand. So 40 units on hand, 40 at I'm sorry, ending inventory is the most recent. 40 at 30. I'm sorry. I'm sorry. I was thinking I had life on my hand. 40 at 30 units. I'm sorry. Wow, it's a big mistake. A big fail there. But obviously, I was thinking LIFO, it's FIFO. So 40 at 30, because we have 40 units on hand. Under FIFO, it's the oldest goods are gone, the newest goods remain, so 40 at 30 remains. And then sort of follow up there, then we have under the FIFO method, under the LIFO method. So we have the same facts, 40 units, it's going to be 40 at 50, and it's going to be 2,000. So that's what's going on there. So relatively straightforward, okay? All right, so we're out of time. So this is where I'm going to sort of pick up on Thursday. I'm going to talk more about what's going on here. I think we have plenty of time to talk about the rest of inventory valuation, particularly this issue of why a company would choose one particular cost flow assumption, which means either average or FIFO or LIFO. Why would they do it? What are the motivations? And what are some of the reasons? And one big hint here is there's a big tax reason why someone would use LIFO, which is, in my mind, probably the biggest reason of all. And we'll get to that. So any questions for me about anything before we wrap up today's class session? All right, I'll post the video for this this afternoon, and we'll finish this up. We'll also on Thursday talk a bit more about the second exam, what to expect on that. So if you have any questions in the meantime, feel free to get with me. I'm here all day, and I'll see you on Thursday.
Thank you, sir.
Yep.
I usually get mixed up on that LIFO and the FIFO.
Oh, I know. Oh, I know. I know. It is.